So we'll talk about annuities. The best example of annuities are, for example, consumer loans, where the borrower pays, rather borrower takes out a loan. It's either a home mortgage loan or car loan, etc. And the borrower pays back the loan in a series of equal payments stretched over many years. So, for example, if I take a loan of, let's say 60, 70 lakhs or spread over 20 years, so that means that I have to pay interest spread over 20 years. So that means obviously most interests are paid on a monthly basis. So I pay 240 installments of interest. If it's a car loan, let's say a 5 year car loan, then I pay 60 installments of interest. So these kinds of consumer loans you see very frequently in the form of annuities. And then the next, very popular kind of annuities are in retirement. Retirement planning or retirement investing. It is used extensively to create retirement savings and as a dependable means to generate safe retirement income. So when you are nearing retirement, or even when you're young, you want to build your nest egg, and so you invest a certain amount in annuities. So if you talk about, and it's a big business, it's a big, huge business in India, and all of the major heavyweight companies like LIC, AIG Life, SBI Life, HDFC, Bajaj Alliance, everybody is in the annuities business, and some reports say that it is around 40,000 crores or something. I don't know what is the exact number, but there are some reports which say that even that is minuscule compared to the size of the potential market, or the potential size of the market. And it's a very under targeted market, and there's huge potential in insurance in India, whether it's health, or whether it's life insurance, or even in life insurance or retirement planning. And not many people really are paying attention to this, so there can be a huge potential. And for students in finance, actuarial science is full of different types of annuities, and there's huge scope for somebody who is a little bit mathematically involved. I mean, you don't have to be an Einstein in mathematics. Just understand the basics of annuities, future and present value functions, and annuity, the math involved in annuities. So that's it. I mean, it requires like a class 12 kind of maths. So all in all, it's a huge market, and annuities also have present and future values. So, and as I said earlier, the finance world is full of situations that deal with annuities. So very briefly, let's look at different types of annuities. Of course, one can have a real course, full course on annuities. So, but here I am just going to mention, just for the sake of the financial mathematics webinar, I am just going to mention very briefly 1,000 feet perspective on annuities. So annuities can be either fixed or variable. So what does that mean? Fixed annuity means that there is guaranteed periodic payments that you get based on the corpus, the interest rates, etc. So, and variable annuities are payments which are linked to the performance of an underlying benchmark. So, if you have an annuity plan where you can have part fixed and part variable. So the fixed portion has a very high risk management profile. Typically what you see in bond payments, fixed income payments, And variable annuity is typically linked to a equity benchmark, and so you can take advantage of the market upswings. Okay, but then there is also a risk, so you have to maintain a balance. Okay, so now the kind of payments regime that you have, you can have an immediate payment or deferred payments. So immediate payment plans start working from the vesting phase. So basically, these type of annuities is when you invest a large sum of lump sum money. So, for example, 50 lakhs, you have 50 lakhs and you want to invest that on your retirement, and so you just make the 50 lakh lump sum amount, and so depending on the annuity, the your payment immediately starts, okay, at a certain date. And while deferred plans start working after a certain dates, and this is called the after the accumulation phase, and there are certain tax benefits on premium paid, towards the annuity. Okay, and then these are the different types of annuities. So, for example, you can have a life with return of purchase price, guaranteed period, inflation index, joint life survivor, and joint life with return on purchase price. So, I mean, the definition of these, you can just look it up in Google or something. I don't want to go too much in detail about annuities. Suffice it to say that there are many different types of annuities, and then constantly there are new types of annuities that are being created by different insurance companies. Okay, so this is a general overview of annuities. So now we will look at certain examples of annuities. We have here a problem which says that it's an investment which pays 10 lakhs at the end of each of the 3 years. So we make an investment now at present, and then it promises to pay us a cash flow of 10 lakhs in year 1, 10 lakhs in year 2, and 10 lakhs in year 3. And so a discount rate is given as 7%. So as before, we calculate what is the present value of each of these cash flows, okay, and then sum them together. So cash flow one is denoted by this cash. This should be cash flow two, for example. Okay, not cash flow one. Okay, so this is present value of cash flow two, and this is present value of cash flow three. Okay, so once we find out these cash flows and we take a sum of all these cash flows, it's come to 26.24. Now, how we did this problem is by using conventional discounted cash flow formula, and we get a PV, present value of 26.24. Now, let us try by using the annuity formula directly. Okay, so same problem, at the end of each of the years, I get a cash flow of 10 lakhs. Time horizon is 3 years, that is the number of periods is 3 years, and an annual interest rate or annual discount rate of 7%. And here we see this PMT, or payment is 10 lakhs. Now this is equivalent to a cash flow. Consider this to be a cash flow. So we are getting a payment of, rather, we are getting a cash flow of 10 lakhs. So we in standard annuity problems, the cash flows occurring in each of the periods is denoted as PMT. Of course, you can denote them as anything, but conventionally we denote it as PMT. So the formula of a present value of an annuity, PV, is given by this formula. Okay, so we have PMT times 1 minus 1 divided by R to the power T, and the whole thing divided by R, where T is the number of periods. Okay, so now what we do is this particular 1 divided by 1 plus R to the power T, we have substituted that for PVF, which is the present value factor. So just for the sake of visual clarity and visual simplicity, we have assumed this. Otherwise, we can just keep this as it is. And so, what is PVF? PVF is 1 divided by 1 plus R to the power T. And so, so all these are given. So PVF comes to 0.816. So now, what is another term we use is the annuity present value factor, which is 1. So this is the one. So 1 minus PVF divided by R. Okay, so if we substitute, the values of each of these components, we get a value of 2.624. Okay, and so the present value of the annuity is payment multiplied by APVF, which is the annuity present value factor. Now it just sounds complicated, but if you look at this problem step by step, it becomes very easy. Okay, so there's no confusion. So the present value of the annuity is payment multiplied by APVF, which comes to 26.24 lakhs. Now this is exactly the same as the value that we got by using conventional discounted cash flow methodology. So what does that mean? That means that these two methods are equivalent. Okay. So now on all future problems we can just substitute or apply this formula and we will get our results. Okay. Let us take another example, which is a home loan. And what is required to find out is how much of home loan I can afford. Okay, so now I have a 20-year home loan. So yearly there are 20 periods. We I can make a payment of 60,000 rupees per month. Okay, now that works out to 7.2 lakhs per year. As before, we simplify this problem so that all the payments are lumped together into one payment at the end of each year. So at the end of year one, I make a payment of 7.2 lakhs, year two, year three, etc. And interest rate is 9%. Annual interest rate is 9%. Now loan to value is 90%. Now what is this loan to value? That means that, for example, you have you want to buy a flat. Okay, the flat costs one crore, and so you go to the bank and you tell them that I want a loan of 1 crore. No bank will give you the entire full amount as loan. So no matter how high your credit rating is and how stable your employment status is and all your financial net worth, etc., no bank will give you the 100% amount that is the cost of the flat. That is because every bank has quite strict risk management policies, etc. And so what they do is they give you, let's say, for example, 80% or 90% of the cost of the flat as loan. So some amount you have to put in as your own contribution. Okay, so that means that you have the skin in the game. And so for example, they put in 90. So if the flat costs 1 crore, the bank will give you 90 lakhs of loan. So the loan to value, that is, loan is 90 lakhs and the value of the flat is 1 crore. So 90 divided by 1 crore is 9 by 10, which is 90%. So loan to value is 90% in this case. Now in some cases they may only give you 80%. So the loan to value is 80%. Okay, so now we, as before, we calculate the present value of the annuity by substituting the various numbers, and so we calculate the present value of the annuity. Okay, so now that is given by 65.726 lakhs. Now this is the loan amount. Okay, so now this is not the flat, the cost of the flat. Okay, now we what is given is that the loan to value is 90%. So what does that mean? That means that the loan divided by the cost of the flat. So that means that a loan to the cost of the flat is 90%. Therefore, the cost of the flat is just interchange the numbers in the equation. So see, for example, cost of the flat is loan value divided by loan amount divided by LTV, which works out to 73.02 lakhs. Okay, so this is how you calculate what is the present value of an annuity. So this is a example of a business loan where what is asked for is what is the repayment. That means what is the payment, what is the monthly or periodic payment that one needs to make as a result of the loan. So now let us say that the company has taken a loan of 50 lakhs. The time horizon is 5 years at an interest rate of 12% annual, and assume that the payments are made at the end of each year. So 50 lakhs loan, and what is asked for is how much payment that the company has to make at the end of each year. So PV equal to 50 lakhs, payment is asked for, R equal to 12% and T equal to 5. Similarly, you just substitute the numbers, and then you solve for what is the payment. So here we get payment equal to 13.87, and so yearly payment. So this is yearly payment. So yearly payment is 13.87 lakhs, and so monthly payment is divided by 12, which is 1.15. So you can see that different components of the present of the annuity, when they are asked, we can easily find out by substituting what is given into this formula, and we can get the unknown, the formula. So now we all this is basically finding out the present value, the payment, etc. So we can also find what is the future value of an annuity. Now look at this problem, which is like a pension scheme. So it offers a pension plan whose details are as follows. So you make a monthly contribution of 5,000 rupees, which means that again, for simplification, we convert it to a yearly payment. So an year monthly contribution of 5,000 rupees is an yearly contribution of 60,000 rupees. So the tenure is 20 years. The yearly interest rate is 9%. Okay, so now how much money will I have at the end of T years, which is at the end of 20 years? How much money will I have? Okay, so now same thing, we apply the annuity problem, and what we do is we get a present value of this annuity. Okay, so once we get the present value, we know what is the tenure, what is the time period, and we know what is the interest rate, and so it's very easy to calculate what the future value of this annuity is. So the if the present value we found out is 5.447 lakhs, therefore future value is 30 lakhs. So that means that if I make a one time initial payment of 5.47 lakhs, and then every year I make a payment of 60,000 rupees, then at the end of 20 years my money will grow to 30.69 lakhs. So this is another type of problem. Now, the next kind of problem is what is the time to repay? Once you take a loan, all the other factors are given, namely present value, what is the payment, periodic payment, what is the interest rate, and so what is T? Okay, so what is the time period of the loan given these conditions? So the present value is 50 lakhs. Okay, so what does that mean is that you make a you basically take a loan of 50 lakhs, and you have a constraint that every month you can pay only 1 lakh. Okay, and interest rate is 1% per month. See here, it's not yearly interest rate, it's a monthly interest rate. Okay, so now T, because this is monthly, our T will be in months. Okay, if interest rate were yearly interest rate, then T will be in years. Okay, so now given in this problem, our interest rate is given in the form of months, which is 1% per month. So you take the help of the annuity problem, and so now you get this after substituting, etc. You get this. Okay, so now what happens is 1 plus r to the power t equal to 2. Now it's quite difficult, using conventional algebra to solve for r. So we put log on both sides. So you have t times log 1 plus r equal to log 2. So therefore, now we know that r is 1% per month. Okay, so now therefore we can find out by taking the log, we can find out what is T. Okay, so T is 69.66 months. Remember, R is in months. We have not converted this to years. And so T is 69.66, thereby T is 5.81 years. So you see different factors in the annuity factor, in the annuity formula can be found out by substituting what is given into this formula. So you see how simplified this becomes. Now the last problem that we will see is what is the rate, okay, and what is the implied rate. Why do I say implied rate? That will be clear as we do the problem. So here the what is given is that, for example, LIC offers to pay you 1 lakh per year for 10 years. Okay, if you pay 6.71 lakhs upfront. Okay, so thereby here at the beginning of the investment, you pay a lump sum amount of 6.71 lakhs. Okay, so once you do that, then LIC will pay you at the end of year one. They will make a payment of 1 lakh. At the end of year two, 1 lakh. At the end of year three, four, five. So similarly, they pay you 1 lakh, and this goes on till 10 years. Okay, so what does that mean? That means that present value is 6.71 lakhs, payment is 1 lakh. What is r is supposed to be found out, that is the unknown, and t equal to 10. Similarly, you put the value of the present value of, rather the formula of present value of an annuity, and then so you get this big equation, or rather this um, um, yeah, I mean this formula equal to 6.71. Okay, so now see, intuitively it looks a bit difficult to find out what this is, and so a simplification of this is by doing a trial and error. And as we saw in the introduction of annuities, it's a sort of an inexact science, if you will. And so we create a table and we substitute the various values of R, okay, and see if, having substituted these values of R, we get a PV which is exactly the same as this, because this we know this is the PV. So and because LHS equal to RHS, which is the left hand side equal to the right hand side. So substituting a value of R in the left hand side of the equation, we see what appears in the right hand side. And so if there's a value which is either equal or very very close to 6.71, so we assume that that is the discount, that is the discount rate. Okay, or so that is the implicit rate or the implied rate, because it's not exact. Okay, so for example, we have to start somewhere, so we start at 10%. So by putting 10%, we get a present value of 6.14. Now let's say now we put 11%. So by putting 11%, our value goes down actually. We want a value which is close to 6.71. So the value obtained from putting R equal to 10% is 6.14, but we want a higher number. So whereas by putting 11%, actually the value becomes lower. So basically, that what does that mean? The we need to put a number which is lower than level, than 10 rather. So if we substitute the R with 9%, so we get a value of 6.41, which is closer to 6.71. Okay, but not close enough. So let's see if we put 8%. So if we put 8%, then we get a value of 6.71008, which is acceptable, okay, which is close enough to 6.71. So what we say is that the implied discount rate is 8%. Okay, so we don't say it's exactly 8%, because you see here this is 6.71. This still it's not exactly the same as 6.71. It's a 6.71008, and so that's the reason why the rate is implied. Okay, so now we have seen enough variety of annuities, and also most of the problems in annuities will circle around some of these kinds of problems. The only challenge is to find out what is the cash flows, that you have to consider as annuities. Okay, so that is the main challenge. So now we will look at um, perpetuity. So what is perpetuity? We know that annuity is a series of cash flows of equal value, okay, for a fixed period of time. Okay. However, perpetuity is series of cash flows for that of equal value that continues for an infinite amount of time. Okay, or you have an infinite number of cash flows. So the formula for perpetuity present value is PV equal to cash flow divided by R. Okay, so that is the formula for a perpetuity, formula for present value of a perpetuity. So now if we take an example, an investment offers a perpetual cash flow of 5,000 rupees every year. You require an annual rate of return of 8%. So what is the value of this investment, or what is the present value of this investment? So we have cash flow equal to 5,000. We have R equal to 8%. Therefore, the present value equal to CF divided by R, which is 62,500. Okay, so that's a perpetuity. Another thing is, we take an example of preferred stock. Okay, so what is preferred stock, and what is the how do you model the cash flows and all, is a matter of another topic. So we are not going to delve into that. Suffice to say that we will deal with the problem as it is given here. That means that a firm XYZ wants to sell its preferred stock for 100 rupees per share. Okay. However, there's a similar issue of preferred stock which is outstanding and has a price of 40 rupees. Okay. Now, what do you mean by a similar issue of preferred stock? Now, in finance theory, two instruments are supposed to be similar or equivalent, or if both of the cash flows are the same. Okay, so now this particular preferred stock, what the problem says is that a similar issue of preferred stock is outstanding, and it has a price of 40 rupees and offers a discount, or rather offers a dividend of 1 rupee per quarter. Okay, so 1 rupee every quarter the company offers a dividend. Now the question is, what should XYZ offer as dividend so that the preferred stock may find a market? That is the second preferred stock, which which is being sold by XYZ. So what he's asking for is that what should XYZ offer as dividend, okay, for this firm. to their shareholders. Okay, so now, as I said earlier, two investments are equivalent if the cash flows generated by them are both of them are equal or the same. So the existing issue of preferred stock is selling for 40 rupees. Therefore, present value is 40 rupees. Now, there's only one cash flow. Okay, that's what the problem says. Okay, so rather the cash flow is 1 rupee because that is a dividend. Every quarter, the cash flow is the dividend is considered to be the cash flow, which is 1 rupee per quarter. Now, how do you calculate the present value by substituting this formula, cash flow divided by R. Okay, and cash flow divided by R equal to 2.5%. Okay, so now cash flow here R equal to cash flow is 1 and present value equal to 40. That's what is given in the problem. Okay, so that comes to 2.5%. So similar is so that you can think of it as a rate of return. Okay, so similar rate of return is being assigned to the original problem. That means this preferred stock whose price is 100 rupees. Okay, so now the present value in this case is 100. The rate of return is 2.5%, and the stock. So now we calculate what the present value is. Let's say 100. This cash flow is required to be found out. And R we know is 2.5%. So now substituting the values, we get a cash flow of 2.5 rupees. So that means that the company has to pay a dividend of 2.5% every quarter, or rather 2.5 rupees every quarter. Okay, so that is the treatment of perpetuities. Now we come to another very important subject called the internal rate of return. Okay, so the internal rate of return is that particular discount rate, which makes the NPV equal to zero. Okay, so it is also similar to a discounted cash flow. So a discounted cash flow, you have the what do you call it, the discount rate, and so it is that discount rate which makes the NPV equal to zero. Okay, so now the that is why it's also called the discounted cash flow discount rate. Okay, discounted cash flow rate rather. So now you have the a problem here. Now XYZ wants to expand its capacity by adding an additional machines worth 100 lakhs. The project life is 3 years from inception, and it generates an additional cash flow of 40 lakhs. Okay, in each of the years. Annual cost of capital is 7%, or in other words, the discount rate is 7%. So, what is asking is what is the IRR of the proposed investment? Okay, so now let's see what is given. Initial investment is 100 lakhs. Time horizon is 3 years. Number of periods is 3 years. And cash flow in year 1, year 2, year 3 is 40 lakhs. Okay, and discount rate is 7%. So this is the present value, the sum of all the cash flows occurring in each of the periods. So if now IRR is the discount rate which makes NPV equal to zero. So present value function, or rather the present value is the discount discounted cash flows and summing those discounted cash flows, which comes to 104.97 lakhs. Now, if it were a simple present rather NPV problem, then you would be happy and you would say that, yeah, I mean, we have a positive NPV and so the project can go ahead. Okay, however, that is not what we are looking for. What we are looking for is the internal rate of return. Okay, so now we get an NPV here of 4.97. So, but however, the NPV is we are looking for is zero. Okay, so at that point, what is the discount rate? Okay, so now again we undertake a trial and error method, and we say okay, so now instead of 7, let us make it 8. And so notice here the NPV is positive 4.97. So if we put an 8% uh, discount rate, what does it become? So okay, so it reduces. So reduction is good. So we have a fairly quick way of um, uh, you know assigning various numbers and find out what the NPV is. So now 8%, and now let's see what happens if we put 9%. So again it is reducing. However, this should go to zero. But so however, increasing the discount rate is bringing us closer to zero. So let's say 9.5. Okay, still it's positive. It hasn't become zero. However, we are quite close. So if we put 9.6, okay, still it is. So now let us look at 9.7. Voila. So if we put 9.7, then our NPV becomes zero. So that means that our IRR is equal to 9.7, which annual number. So we have considered various discount rates, and here we have ensured that the NPV is close to zero. So, what we did in this session was we have considered various kinds of annuities in different settings, whether it's personal finance or whether it's corporate finance. Then we considered perpetuities, which is a sort of a special case of annuities, and then we considered to be IRR. So, with this, we have completed most of the financial mathematics areas, and then as we go further, if there are any specialized areas where we need to sort of study up some of the mathematical finance techniques, we will do so as soon as we come to those kinds of situations.